Question 1. An individual who holds a life-only agent license in California is authorized to transact which of the following? A. Life insurance and annuities. B. Life insurance, annuities, and variable contracts. C. Life insurance, annuities, and disability insurance. D. Life insurance, annuities, disability insurance, and property and casualty insurance. Answer: A. Life insurance and annuities. In California, a life-only agent license specifically authorizes the licensee to transact life insurance policies and annuity contracts. This license scope focuses on products designed to provide benefits upon death or to accumulate funds for retirement. While other licenses exist for different lines of insurance, the life-only designation is distinct and limited to these particular financial instruments. Remember that the life-only designation accurately describes the permissible scope of practice. Question 2. A life insurance policy's grace period typically allows the policy owner how many days after the premium due date to pay the premium before the policy lapses? A. 7 days. B. 10 days. C. 20 days. D. 31 days. Answer: D. 31 days. The grace period is a provision in a life insurance policy that allows the policy owner an extended period, typically 31 days, beyond the premium due date to pay the premium without the policy lapsing. During this time, the policy remains in force, and if the insured dies, the death benefit would be paid, less any unpaid premium. This provision protects policyholders from losing coverage immediately due to a minor delay in payment. Always remember that the grace period is designed to prevent unintentional policy lapses. Question 3. Which of the following is the primary purpose of the California financial solvency requirements for insurers? A. To ensure insurers charge competitive premium rates. B. To protect consumers by ensuring insurers have sufficient funds to pay claims. C. To regulate the marketing practices of insurance agents. D. To provide state funding for consumer insurance education programs. Answer: B. To protect consumers by ensuring insurers have sufficient funds to pay claims. The California financial solvency requirements, enforced by the Department of Insurance, aim to ensure that insurance companies operating in the state maintain adequate financial reserves and capital. This is crucial for consumer protection, guaranteeing that insurers will be able to fulfill their contractual obligations and pay out legitimate claims when they arise. Without these strict financial standards, consumers would face a significant risk of an insurer becoming insolvent and unable to honor its policies. Always remember that solvency regulations are about an insurer's ability to pay. Question 4. All of the following are characteristics of a participating life insurance policy, except A. It may pay dividends to the policy owner. B. It is typically issued by a mutual insurance company. C. It requires the policy owner to participate in investment decisions. D. Dividends are considered a return of unneeded premium. Answer: C. It requires the policy owner to participate in investment decisions. Participating life insurance policies, usually issued by mutual insurance companies, allow policy owners to share in the company's divisible surplus through dividends. These dividends are considered a return of unneeded premium, not taxable income, and policy owners do not participate in investment decisions. The key characteristic of participating refers to the policy owner's eligibility to receive dividends. Don't confuse participating with making investment choices. It refers to the sharing of profits. Question 5. The clause in a life insurance policy that prevents an insurer from denying a claim due to misstatements in the application after the policy has been in force for a specific period, usually 2 years, is known as the A. Grace period clause. B. Reinstatement clause. C. Incontestability clause. D. Entire contract clause. Answer: C. Incontestability clause. The incontestability clause is a crucial provision stating that after a life insurance policy has been in force for a specified period, typically 2 years from its issue date, the insurer cannot challenge the validity of the policy or deny a claim based on misrepresentations or omissions in the original application. This protects policyholders from having a policy voided years later due to an innocent mistake made during application. It provides peace of mind that once the contestable period passes, the policy is generally safe from insurer challenges. Question 6. Which of the following statements regarding the taxation of life insurance death benefits is generally true? A. Death benefits are usually taxable as ordinary income to the beneficiary. B. Death benefits are typically received income tax-free by the beneficiary. C. Death benefits are always subject to federal estate taxes. D. Death benefits are taxable only if the policy's cash value exceeds the death benefit. Answer: B. Death benefits are typically received income tax-free by the beneficiary. For the beneficiary, the death benefit from a life insurance policy is generally received income tax-free at the time of the insured's death. This tax advantage is a significant feature of life insurance, providing a valuable financial cushion to the surviving family without additional tax burdens on the payout itself. While there can be exceptions, such as transfer for value rules or certain estate tax implications, the fundamental principle for beneficiaries is income tax exemption. Remember this key benefit: a tax-free payout for the beneficiary. Question 7. What is the primary purpose of the Medical Information Bureau, MIB? A. To conduct medical exams for insurance applicants. B. To provide a centralized source of medical records for all U.S. citizens. C. To deter misrepresentation and fraud by collecting and sharing coded health information among member insurers. D. To assist insurers in determining the exact cause of death for claims. Answer: C. To deter misrepresentation and fraud by collecting and sharing coded health information among member insurers. The Medical Information Bureau, MIB, is a non-profit association that operates an information exchange for life and health insurance companies. Its primary purpose is to help underwriters identify individuals who may have withheld or misrepresented significant health information on their insurance applications. The MIB provides coded reports of medical conditions, hazardous avocations, or other relevant facts discovered during previous insurance applications, helping to prevent fraud and maintain fair underwriting practices. It acts as a flag system, not a detailed medical record provider, encouraging applicants to be truthful. Question 8. Under a life insurance policy, who has the right to change the beneficiary, borrow against the cash value, and assign the policy? A. The insured. B. The beneficiary. C. The policy owner. D. The insurer. Answer: C. The policy owner. The policy owner is the individual or entity who possesses all contractual rights and controls over a life insurance policy. This includes the fundamental rights to change the beneficiary, take out policy loans against the cash value, surrender the policy, assign policy ownership, and make other administrative changes. While the insured is the person whose life is covered and the beneficiary receives the death benefit, it is the policy owner who holds the legal control. Always remember that control and rights lie with the policy owner. Question 9. In California, if a life insurance policy is sold to an individual aged 60 or older, what is the minimum free look period allowed? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. For life insurance policies and annuity contracts sold to individuals aged 60 or older in California, state law mandates a minimum free look period of 30 days. This extended period, compared to the standard 10-day period for younger applicants, provides older consumers with more time to review the policy, understand its terms, and decide if it meets their needs without financial penalty. This consumer protection measure is designed to reduce the risk of buyer's remorse or undue influence on senior citizens. Remember this important difference for older applicants. Question 10. A universal life insurance policy is characterized by its A. Fixed premiums and fixed death benefit. B. Flexible premiums and adjustable death benefit. C. Level premiums and increasing death benefit. D. Single premium payment and immediate cash value. Answer: B. Flexible premiums and adjustable death benefit. Universal life insurance is a type of flexible premium adjustable life insurance. It allows the policy owner to vary the amount and timing of premium payments, and the death benefit can also be adjusted up or down, within certain limits. This flexibility is achieved because the policy has a separate cash value account that earns interest, from which charges for insurance coverage and expenses are deducted. Universal life provides more adaptability than traditional whole life, allowing the policy owner to adjust to changing financial circumstances. Question 11. Which of the following statements about term life insurance is true? A. It builds cash value over time. B. It provides coverage for the insured's entire life. C. It provides coverage for a specific period of time. D. Premiums remain level throughout the policy's duration. Answer: C. It provides coverage for a specific period of time. Term life insurance is designed to provide coverage for a defined period, or term, such as 10, 20, or 30 years. If the insured dies within that term, the death benefit is paid to the beneficiary. However, term life insurance does not accumulate cash value and the coverage expires at the end of the specified term, unless renewed. It is often chosen for its affordability and suitability for temporary needs, like covering a mortgage during its amortization period. Question 12. The incontestability clause in a life insurance policy generally states that after 2 years, an insurer cannot deny a claim based on A. Misstatement of age or sex. B. Lack of insurable interest at policy inception. C. Fraudulent statements on the application. D. Misrepresentations in the application, unless they involve fraud. Answer: D. Misrepresentations in the application, unless they involve fraud. The incontestability clause typically prevents an insurer from voiding a policy or denying a claim based on misrepresentations in the application after a specified period, usually 2 years. However, this clause generally does not apply to outright fraud or misstatement of age or sex. Insurers can usually adjust benefits or deny claims for these specific issues even after the contestable period. The clause is primarily designed to prevent an insurer from contesting minor or even material misstatements that are not outright fraud after a reasonable time has passed. Question 13. Which of the following is a key characteristic of an annuity? A. It provides a lump sum death benefit. B. It primarily protects against the risk of premature death. C. It is designed to liquidate an estate or provide income during retirement. D. It offers a flexible death benefit that can be adjusted. Answer: C. It is designed to liquidate an estate or provide income during retirement. An annuity is a financial product designed to provide a stream of income payments, typically for retirement, by systematically liquidating a sum of money over a period or for life. Unlike life insurance, which protects against the risk of dying too soon by providing a death benefit, an annuity protects against the risk of living too long and outliving one's savings. It can be funded with a single premium or a series of premiums. Always remember that an annuity is about income for life, protecting against longevity risk. Question 14. What is the primary purpose of the California Life and Health Insurance Guarantee Association? A. To regulate premium rates charged by life and health insurers. B. To provide a safety net for policyholders in the event an authorized insurer becomes insolvent. C. To promote consumer awareness about different types of life and health insurance policies. D. To enforce ethical conduct among insurance agents. Answer: B. To provide a safety net for policyholders in the event an authorized insurer becomes insolvent. The California Life and Health Insurance Guarantee Association, CLIGA, was created to protect policyholders and beneficiaries of life and health insurance policies and annuity contracts in the event that a member insurance company becomes financially impaired or insolvent. The association steps in to pay covered claims up to certain statutory limits, providing a vital safety net and preventing policyholders from suffering financial losses due to an insurer's failure. This acts as a form of consumer protection, similar to FDIC for banks. Question 15. The owner of a variable life insurance policy bears which of the following risks? A. Interest rate risk for the insurer's general account. B. Investment risk of the separate account. C. Lapse risk due to non-payment of fixed premiums. D. Underwriting risk of the insured. Answer: B. Investment risk of the separate account. With a variable life insurance policy, the cash values are invested in a separate account, which is typically comprised of various sub-accounts chosen by the policy owner, similar to mutual funds. Because the policy owner chooses the investment options, they also bear the investment risk, meaning the cash value and potentially the death benefit can fluctuate based on the performance of these underlying investments. This differs from traditional whole life where the insurer bears the investment risk of the general account. Remember that variable means the policy owner takes on the investment risk. Question 16. What is insurable interest in the context of life insurance? A. The amount of cash value accumulated in a policy. B. The financial interest a beneficiary has in receiving the death benefit. C. A legitimate financial or emotional interest in the preservation of the life of the insured. D. The interest rate used to calculate policy dividends. Answer: C. A legitimate financial or emotional interest in the preservation of the life of the insured. Insurable interest means that the policy owner stands to suffer a genuine financial or emotional loss if the insured person dies. This interest must exist at the time the policy is purchased. For example, a spouse has an insurable interest in their partner, a parent in their child, or a business in a key employee. The requirement for insurable interest prevents people from taking out policies on strangers and potentially benefiting from their death, upholding the moral and legal integrity of the contract. Question 17. All of the following are common dividend options for a participating life insurance policy, except A. Cash payment. B. Reduce next year's premium. C. Purchase paid-up additions. D. Increase the policy's face amount without additional premium. Answer: D. Increase the policy's face amount without additional premium. Dividends from a participating life insurance policy are typically not guaranteed and represent a return of premium if the insurer's actual experience is better than projected. Common options for receiving these dividends include taking them in cash, applying them to reduce the next premium due, or using them to purchase paid-up additions, small, single-premium whole life policies that increase the total death benefit and cash value. While paid-up additions do increase the face amount, the option to increase the policy's face amount without additional premium usually describes a feature of increasing term riders or specific policy designs, not a standard dividend option in the way the other choices are. Question 18. An individual purchasing a life insurance policy for the first time is required to sign a notice regarding replacement if they are replacing an existing policy. In California, this notice is primarily intended to A. Inform the new insurer of the existing policy's details. B. Prevent the agent from earning commissions on the new policy. C. Protect the consumer by ensuring they understand the potential disadvantages of replacing an existing policy. D. Accelerate the underwriting process for the new policy. Answer: C. Protect the consumer by ensuring they understand the potential disadvantages of replacing an existing policy. When an existing life insurance policy or annuity is being replaced by a new one, California law requires a notice regarding replacement to be provided to the applicant. The primary purpose of this notice is to inform and protect the consumer, making them aware of the potential disadvantages of replacing an old policy, such as new contestable and suicide periods, loss of grandfathered policy provisions, or higher premiums due to age. This ensures the consumer makes an informed decision and isn't unfairly disadvantaged by the replacement. Question 19. A life insurance policy owner wants to ensure that the death benefit will be paid to their surviving children equally, and if one child predeceases the insured, that child's share will go to their own children. What type of beneficiary designation should be used? A. Per stirpes. B. Per capita. C. Revocable. D. Irrevocable. Answer: A. Per stirpes. A per stirpes, Latin for by roots or by branches, beneficiary designation ensures that if a named beneficiary predeceases the insured, that beneficiary's share of the death benefit will pass down to their heirs, e.g., their children. This contrasts with per capita, by heads, where the death benefit is divided equally only among the surviving named beneficiaries. Using per stirpes provides a structured way to ensure the benefit flows through family lines as intended. Question 20. What is the main difference between level term and decreasing term life insurance policies? A. Level term has a fixed premium, while decreasing term has a fluctuating premium. B. Level term has a fixed death benefit, while decreasing term's death benefit declines over the policy term. C. Level term offers cash value accumulation, while decreasing term does not. D. Level term is renewable, while decreasing term is not. Answer: B. Level term has a fixed death benefit, while decreasing term's death benefit declines over the policy term. The primary distinction between level term and decreasing term life insurance lies in their death benefits. A level term policy maintains a constant death benefit throughout its entire term, meaning the payout remains the same whether the insured dies early or late in the policy's duration. In contrast, a decreasing term policy's death benefit gradually reduces over the policy term, often aligned with a declining debt like a mortgage, providing coverage that diminishes as the financial need decreases. Question 21. Which of the following best describes the entire contract clause in a life insurance policy? A. It states that the policy can only be modified by the insurer. B. It specifies that the policy and the application constitute the entire agreement between the policy owner and the insurer. C. It outlines all the riders and endorsements attached to the policy. D. It defines the rights and responsibilities of both the insured and the beneficiary. Answer: B. It specifies that the policy and the application constitute the entire agreement between the policy owner and the insurer. The entire contract clause is a standard provision in life insurance policies that stipulates that the policy document itself, along with the application, a copy of which must be attached to the policy, constitutes the complete agreement between the policy owner and the insurer. This clause prevents either party from introducing outside documents or oral statements to alter the terms of the contract once it's issued. It provides certainty and clarity, ensuring all agreed-upon terms are within the four corners of the policy. Question 22. An adjustable life insurance policy combines features of which two policy types? A. Term life and variable life. B. Whole life and universal life. C. Term life and whole life. D. Universal life and variable life. Answer: C. Term life and whole life. An adjustable life insurance policy offers the policy owner the flexibility to change the coverage from term to whole life, or vice versa, and also to increase or decrease the face amount of coverage or change the period of protection. This type of policy provides significant adaptability, allowing the policy owner to modify the plan as their financial needs and circumstances change over time, truly combining the characteristics of both temporary and permanent coverage. Question 23. Under what circumstance may an insurer legally decline to issue a life insurance policy to an applicant? A. The applicant has a pre-existing medical condition. B. The applicant refuses to undergo a medical examination required by the insurer. C. The applicant is over the age of 65. D. The applicant has a low credit score. Answer: B. The applicant refuses to undergo a medical examination required by the insurer. Insurers have the right to require applicants to undergo medical examinations or provide medical records as part of the underwriting process to assess the risk accurately. If an applicant refuses to comply with these reasonable requests, the insurer is legally justified in declining to issue a policy because they cannot adequately evaluate the risk. While pre-existing conditions or age might lead to higher premiums or specific exclusions, refusal to provide necessary underwriting information is a direct reason for declination. Question 24. What is the primary purpose of the conversion privilege in a term life insurance policy? A. To allow the policy owner to convert the policy into an annuity. B. To allow the policy owner to convert the term policy into a permanent policy without evidence of insurability. C. To allow the beneficiary to convert the death benefit into a series of payments. D. To allow the policy owner to convert from a decreasing term to a level term policy. Answer: B. To allow the policy owner to convert the term policy into a permanent policy without evidence of insurability. The conversion privilege in a term life insurance policy allows the policy owner to exchange their term policy for a permanent life insurance policy, like whole life or universal life, without having to prove their insurability again. This means that even if the insured's health has deteriorated significantly since the original term policy was issued, they can still obtain permanent coverage. This feature is valuable as it guarantees future insurability, providing a safety net if needs change or health declines. Question 25. Which settlement option provides a beneficiary with a guaranteed income for a specific period or for the remainder of their life, regardless of how long they live? A. Lump sum. B. Fixed period. C. Fixed amount. D. Life income. Answer: D. Life income. The life income settlement option guarantees the beneficiary a periodic income payment for the rest of their life, even if they live beyond their life expectancy and the total payments exceed the death benefit. This option provides maximum financial security against outliving one's funds. Other options like fixed period or fixed amount will pay out the death benefit over a defined period or until the fund is depleted, respectively, but only the life income option guarantees payments for the beneficiary's entire life.